As the world copes with the COVID crisis, governments and central banks are deploying unconventional fiscal and monetary policy tools to provide support to the global economy. This includes dealing with volatile capital flows. In April, the IMF MD warned about a possible flight of capital from emerging markets. She said that at the start of the pandemic, portfolio outflows from emerging markets were about $100 billion. That's more than 3 times larger than for the same period of the global financial crisis. Since then, with the measures taken by central banks, foreign capital that fled India and other emerging markets is returning. COVID-19 aside, we now have a historic election verdict in the US, which could have significant ramifications for dollar inflows. In India, Prime Minister Modi has made a pitch to global pension and sovereign wealth funds to invest, promising a stable, predictable, reform-oriented economic plan. So what are the prospects for countries like India? Should we welcome or worry about foreign capital? The Independent Evaluation Office of the International Monetary Fund has released a report on capital flows around the world and how the IMF needs to revisit some of its policies. Joining me now to discuss the report and the prospects for foreign capital in India and emerging markets are Prakash Lougani, who led the Independent Evaluation Office team on this report. Also with me, former RBI Deputy Governor Acharya, member of the MPC Ashima Goyal, noted economist Patnaik and Anantha Nageswaran. Gentlemen, Ila and Ashima, many thanks for joining us here on CNBC TV 18. Prakash, let me start by asking you, we are in the midst of a humanitarian crisis. The economic environment continues to look highly uncertain. In light of what your report is suggesting, what do you believe is the best way forward for governments and central banks? What would the IMF now be advising?
I think countries have to find a way to remain open to foreign capital, even in the middle of such a huge crisis. I think the benefits of foreign capital are quite evident in particular sectors. So I think it would be a mistake to retreat into isolation. And what our report is trying to do is to find ways in which countries can remain open to capital, and particularly how institutions like the IMF, which go around giving advice to all countries, how can they give good advice so that countries can get the benefits from foreign capital?
What would that mean in the Indian context? As I mentioned, just a few days ago, we had the Prime Minister doing a virtual roundtable with 20 of the world's largest pension and sovereign wealth funds, asking them to put money into India across a bunch of sectors, of course, infrastructure being the big one. In the Indian context, what should the way forward be?
Was this addressed to me, Shereen? Yeah.
Yes, Prakash. Yes.
Yeah. So I think that what our report shows is that the IMF, if anything, perhaps has been a little too cautious in advising India to open up. They have been worried about the financial risks. So I think that, of course, that's a very valid consideration. But I think that the way forward is to find sectors which would benefit from foreign capital, and think about ways to attract foreign capital in a way that's not going to lead to financial crises. And in this respect, it means that allowing actually for greater flexibility in the use of capital controls when it is needed. So I think India and the IMF in its advice have to sort of try to find this balance of how to be open to capital and yet allow for restrictions. That's sort of what our report is getting at, is that you have to find this right balance.
Dr. Viral Acharya, what do you make of this balance, and what do you believe needs to be done in order for us to remain open, remain flexible, to the point that Prakash was making, that perhaps we've been far too cautious? Given where you see the external environment, where you see India's position today, both in terms of foreign exchange reserves, the current account surplus, perhaps that may not be sustainable. But given the domestic context, the external environment, what is this balanced approach, the shape that you would like to see it take?
See, the Reserve Bank of India has always had a fairly prudent approach, in my assessment, towards managing the external sector risks. In response to capital flow volatility and the likely depreciation spirals that they can cause on exchange rates, emerging markets, and notably the Reserve Bank of India, they've adopted 2 main strategies. One is to hoard foreign reserves, which are at our highest levels in India right now, and to impose certain kinds of capital controls. Now, what is the point of holding reserves? The point of holding reserves is that if there is a sudden stop on the capital flows, which will cause the currency to depreciate rapidly, the reserves can be used as a buffer to stabilize excessive volatility in the currency at that time. The key point, though, is that if all your reserves are built out of volatile capital flows, then you have not achieved much. The flows came in, you built up the reserves, the flows go out, and you used your reserves. So the key point is that a part of the reserves should have been either built out of your foreign direct investments or long-term equity kind of flows, or you need to limit some of the hot money kind of flows, such as debt flows, maybe some of the other kinds of very fickle flows that leave the country at short horizons coming. Now, to just sum up, what I'm trying to say is that you do need capital controls, because without capital controls, reserves won't be effective. But the historical evidence has been that this is just the nuts and bolts of what happens when a sudden stop hits you. What you do need first and foremost is macroeconomic stability. You should not have massive fiscal deficits.
Yeah.
Your inflation should not be in a runaway trajectory, and your current account deficit should not be very large. Right now, we are doing okay on the current account deficit front. We'll have to see for how long. But on 1 and 2, the fiscal deficit and the inflation, I don't think we are looking as strong. We do have some time before the likelihood of external sector shock, and we might want to think hard about rebalancing us on those two fronts.
Okay, so since you're saying that on point 1 and 2, which is on the fiscal deficit as well as the inflation trajectory, you're not feeling as comfortable as you would like to be, what will that mean then in terms of possible restrictions? You talked about the need perhaps to look at capital controls given the environment. I mean, I think people have been scarred by what happened in 2013 with the taper tantrums, but, we're nowhere there when you look at the macros for India today. So what are you then advocating as far as restrictions are concerned? You talked about possible restrictions on what you termed as hot money. And more importantly, on this business of using the forex reserves to finance infrastructure, for instance. I mean, is 560 billion enough, adequate? Where do you stand on that?
Quite a few questions there. So first, I don't know if on fiscal and inflation we can really say we look terribly different than at the time of taper tantrum, to be very objective on numbers, I think. The fiscal deficit is likely to be between 10 to 15% of GDP on a consolidated and effective basis, not the official deficit. I don't think that's the real number that matters. And I think our inflation has been running over 6% now for close to 12 months. So I don't think we can just take it for granted that everything is hunky-dory on this front. See, sudden stops, why is it called a sudden stop? If it was coming smoothly, it would not be called a sudden stop. Sudden stops don't announce themselves. Federal Reserve doesn't announce its decision to unwind its policies. It does it on one day, and often it's a surprise because it doesn't want everything to be fully priced in and then gamed by the markets. So I think it may not be immediate risk because the global economies are trying to recover, deal with the COVID and recover out of the shock. But I would say that there is concern on this front. To your second question as to what we need to do, I did not have in mind to suggest that we need to deal with capital flows in order to deal with our fiscal deficit and inflation. I meant that we may have to think hard about what structural reforms are needed in order to deal with fiscal deficit and inflation in the first place. Of course, on the fiscal deficit front, this would require some rationalization of expenditures and reorientation away from subsidies towards infrastructure so that your expenditures are growth enhancing in the long run. On the inflation front, I'm of the view that, we need to recognize that we have been very much above 6% now for 12 months in a row. And I think I find it difficult to just brush that aside. On the last point that you made, which is, are the RBI's reserves to be used for infrastructure, etc.? See, this is a wonky idea that keeps coming back up in India every 5 years or every 6-7 years. Whenever fiscal deficit is tight, you want to solve your problems by dipping into other balance sheets. If we start tunneling the RBI balance sheet the way we tunnel public sector enterprises, we've got to think about which institutions we are leaving as truly autonomous and independent in the country. I would say we should not even encourage this conversation too much because it's really a slippery slope.
Not encourage the conversation, but the conversation is happening. You're right in pointing out that this keeps coming back every few years, and this is a conversation that is currently happening in India. But Ashima Goyal, let me first get you to comment on what we heard there from Dr. Acharya, his discomfort on the inflation trajectory, and more importantly, to the point that was being made on whether India has been perhaps too prudent, the RBI has been perhaps too prudent, too cautious. Do you believe that the time has come now for bolder, more aggressive steps?
I think inflation, unfortunately, last year we had unseasonal rains and it affected the onion crop. So these are purely supply side. And currently, after the lockdown, which totally disrupted supply chains, if you look at specific commodities, both at the CPI and the WPI, consumer and wholesale prices, the inflation rate is much higher in consumer prices than in wholesale. That suggests that it is due to the supply chain disruptions. Now, with Unlock 4, which happened in September, they were clear, and then after that, as infections spread, even though the overall lockdown was lifted, states started imposing arbitrary lockdowns. So this Unlock 4 said that states should not impose restrictions on interstate movements, only in containment zones. So with that and the gradual unlock that we are having, I think there is a lot of improvement in supply chains. But unfortunately, again, rains have been really extended and the onion crop is affected, etc. So it's totally supply side. It's not, you cannot say it's aggregate demand because growth has fallen so much. There's a huge potential output gap. So here, I think enough is happening on the supply side to take care of inflation. And we need to sort of stimulate growth and recovery at this point. Now, about the RBI being too cautious, I agree with Viral that, I think the IMF and prodded by the IEO has shown itself to be a learning organization. Because before the East Asian crisis in the 90s, the IMF had pushed for full capital account convertibility, but some emerging markets got severely damaged following their advice. After the global financial crisis, the IMF has advocated a cautious approach where liberalization follows domestic market and institutional development in each economy. And this is exactly what India has been doing all along. We have been sequencing liberalization of equity before debt. There's been a cap on volatile debt flows. So, like we saw them going out again very rapidly after the COVID-19 crisis. Yeah. So there's a percentage, they're supposed to be 6% of domestic stock currently. And we were the first countries to use macro-prudential policies, before the global financial crisis. And the rest of the world is doing it now. But for us, developing domestic markets is a priority. These restraints on capital doesn't mean that you don't want capital or you don't want markets. You want both. But you have to follow a sequence that reduces risks. Yeah. So you can handle this kind of volatility. For example, in mutual funds, as they've grown and we have continuing equity SIPs, we are able to handle a large amount of FPI going out without it really affecting stock prices too much volatility. So that's an example of how, as domestic markets open, you can raise your caps, allow more capital in. But at present, I don't think we are being too cautious because when you see, as we were discussing, reserves have really increased. That means we are not able to absorb those flows. Yeah, so we need to absorb those flows through higher growth investment and so on. Yeah, private investment as well as other kind of public investment. That's not happening. And then what happens is that the RBI's balance sheet is taken up by inflows and there's no room for it to support government borrowing, to support expenditure, which it needs to do in COVID times. Rest of the world in the advanced economies, central bank balance sheets are really exploding. Here, there are limits to, we don't want to increase money supply too much given inflation. So there has to be space for the Reserve Bank to support government borrowing. Yeah? Thank you.
Fair point. Fair point. Let me get Ela into the conversation as well. Ela, you've heard what Prakash, Viral and Ashima have had to say now. If I were to ask you to take that point forward on the sequencing that Ashima Goyal was just talking about, in light of where we find ourselves today, as well as the uncertain global economic climate, what is it that you would expect to see from here on in terms of the sequencing?
See, if we are looking at the world today where clearly what India wants is for foreign capital to continue to come in, that was exhibited by the Prime Minister's meeting with foreign investors, that we do want to welcome foreign capital, then I think the question that we face is that should we be using capital controls, or should we also be doing other things so that we don't have to use capital controls too much in case of a sudden stop of capital flows. I think the fundamental change in framework that the IMF had, say, from 2012 onwards, was when they said that capital controls are one possible legitimate instrument that emerging economies can use. However, if you look at the entire framework, then that framework says that first you do macro stability. And I think that's what Viral was also emphasizing, that, you know, if our fiscal deficit is under control, if our inflation is under control, those are the things that really will matter much more. They'll matter to whether we get these sudden outflows or not. And, you know, the question of what we can do about them using capital controls comes next. Here I want to raise a point, which I think there's been a lot of this kind of debate which keeps coming back up, that you throw the baby out with the bathwater. In case you have higher inflation, you just get rid of the inflation targeting framework. And I just want to emphasize that we should absolutely not try to create macroeconomic instability by doing such things. Not only will it cause policy uncertainty, you know, when the time comes to review the inflation rate, that's what we should be reviewing. I mean, that's up for review in 2021. It is not the framework that is up for review. And any such discussion that, you know, just because in the first 4 or 5 years we were not able to achieve the targeted rate, so we should just stop trying to do it. We should stop trying to improve the transmission mechanism. We should stop trying to control our fiscal deficits. We should stop trying to get low and stable inflation. I think we should, you know, be like, I think as a profession, as economists, we should be far more responsible and not be talking about some of those issues. Now, before I end,
we've been pushing that very hard here, Ela. We've been pushing that very hard here. That don't throw the baby out with the bathwater, at least on the issues that you were raising. Go ahead.
Yeah. So on coming to capital controls, so when we look at India, one of the big problems that we've had is that there are multiple regulators. You know, you have SEBI doing something, you have RBI doing something, you have the insurance regulator putting restrictions, you have multiple regulators putting capital controls through a number of instruments. So it doesn't have rule of law, it doesn't have transparency, it doesn't have clarity. You know, you have these companies have to go to lawyers who find ways for you know, navigating through India's capital controls. It's something that is not comparable to what you have in other countries other than in China. So China and India are pretty close. But what we need, even if we are going to do capital controls, but what we need is transparency, rule of law. Let businesses see what they are grappling with. You know, not that it's something that you find a way around.
Fair point. I think a lot of people would agree with what you've just said. But Anantha, Nageswaran, let me come to you now. You know, we've been focusing on what India needs to do, but let's talk about the complexities that we're seeing with the global economy. I mean, central banks world over continue to be extremely accommodative. There is money sloshing around. We've got perhaps Joe Biden and Kamala Harris, who will take forward what happens with the U.S. economy in January. Of course, President Trump not giving up just yet. But, you know, given this sort of complex cocktail that we're talking about globally, what kind of challenges will it throw up for central banks, including central banks here in India?
Thank you. Although I am on the Economic Advisory Council to the Prime Minister of India, I am speaking in my personal capacity. So we are having this conversation just a week after both the Bank of England and the Federal Reserve met. Bank of England had decided to increase its quantum of asset purchase, And Federal Reserve said it stands ready to do so if warranted, and reiterated its pledge to target an average inflation rate, etc. So we are facing a situation similar to what we faced post 2008 up to 2012 or 13. This time it could last much longer, and the magnitudes are much bigger, which is basically extremely accommodative monetary policy resulting in huge capital flows, which we will have problem digesting. So the spillover is going to be quite considerable. What was funny about the discussion that the IEO had with officials in India and China was that while the officials in India and China were actually telling them that IMF sometimes was too cautious in advocating capital account liberalization, they also expressed concern about the spillover impact. I think both are contradictory. And when we talk about the impact of capital, we are talking about aggregate demand management, which requires multiple indicators of overheating. And inflation just happens to be one of the indicators. So we have to define what we mean by the baby and what we mean by the bathwater.
Fair point. I'll get Ela to come back on that. But just on the point that you were making, Mr. Nageswaran, on the spillover impact, as well as the challenges that that is likely to pose, and the contradiction that you saw in the conversations that were happening with the IEO and officials here in India, what should be, in Ela's words, the legitimate tools that one should look at going forward?
All tools are legitimate and are on the table, and that includes both fiscal and monetary policy. And yes, while fiscal policy, as Viral pointed out, the combined fiscal deficit could be anywhere between 10 and 15% of GDP in the coming year, and that does need to come back to a medium-term sustainable path. The central banks can use both monetary and macroprudential tools, and they shouldn't be apologetic about it. So it is the communication that matters. And secondly, as India expressed to the IEO team that IMF should have been a lot more supportive of their measures taken in 2013, that is also required, because these things should not be seen as some sort of awkward defensive measures taken by a vulnerable country. They are legitimate tools of macroprudential policy to ensure financial stability in the face of unprecedented policy measures against orthodoxy adopted by central banks in the developed world.
Prakash, let me get you to comment on what we just heard there from Mr. Nageswaran. I think there has been an acknowledgement on the lack of proactive measures or support from the IMF, especially in light of the lessons and the experience post-2013. What are the learnings that we should focus on going ahead?
Yeah, I think Anantha has characterized the report's findings absolutely accurately. I mean, we had very confidential interviews that, Ela Patnaik conducted for us with senior policymakers in India. And they do feel that in 2013, the IMF should have been more supportive of the use of the package of measures, including some capital controls that we used. It was a very delicate situation. Rupee was depreciating a lot over a small number of months. And I think there was a really need for support. And the IMF did provide support, but 6 months later, when, the then managing director, Lagarde, came to India and had photo ops with Raghu Rajan and others. So I think that the support came, but it was by the time the crisis had passed. So I think one lesson is for the IMF that when you're faced with giving advice to major emerging markets like India and China, which, by the way, felt the same in 2015. China also felt a lack of support. So I think the one lesson is that in really extreme stress situations like this, you have to come through for the countries and acknowledge that, heterodox measures, including capital controls, are going to be needed. And so, as I said at the outset, this balance that the IMF needs to strike, remain open to, pushing for foreign capital where you think it's going to make a difference to the country's growth prospects, so don't back away from that. But when there is a need for the use of controls, as Anant was saying, don't be hung up on some kind of orthodox view. Measures will be needed, and the IMF should be more supportive of them.
Ila, since you were the one who was doing these interviews, as Prakash pointed out, while this report was being put together, let me ask you, what are the lessons, the learnings that one will need to focus on, or one should focus on as we move ahead and deal with what is going to continue to be an uncertain environment?
See, first of all, one big important lesson is that when we allow capital flows, when we welcome capital flows, then these come with risks. And these risks are such that even when we try to do the best we can in terms of putting controls in, or keeping macroeconomic stability, sometimes we will need support even beyond that. So things like credit lines, like the US gave to some countries after the difficulties that some countries faced when their currencies were depreciating, or which the IMF can give, we might need some of those. So when we think about capital flows that will be coming in, so we'll need them to come in, and they will come in, we have to be very alert and very prepared about what are the things that we are going to try to do, so that one, we don't even see the sudden stops. So we'll try and keep our inflation low, we'll try and keep our macro stability. But over and above that, if there are sudden stops, then how are we going to deal with them? How are we going to deal with them in a way such that we don't hurt ourselves? That we don't slow down the economy too much, or we don't hurt ourselves. And I think that was part of what came out in terms of the lessons, that we did need support from the IMF, from the G20, from other countries. And the groundwork hadn't been done before the taper tantrum, and we didn't really get that support at the time. That communication was not open. So we're hoping that this IEO report...
But what kind...
Yes, go on, Shereen.
Will change the approach. No, Ila, I was just asking you that, since you said that that support was not as forthcoming as it should have been in 2013, which has been acknowledged, in light of where we find ourselves today, and more importantly, the needs and requirements that we have, you said that we will need support. What kind of support do you believe we will need, and that should be forthcoming this time around?
So one thing would be, in case there is a sudden stop, can we talk about opening credit lines right now, so then we don't actually face depreciation pressures, and we don't have to actually then go around putting capital controls. So we could be talking about some of those things now when we are facing heavy capital inflows. And the approach should not be, look, go deal with it yourself. Self-insure. That is what was done in the taper tantrum. That you go solve your problem, whereas the problem has actually been created by the US. But when it comes to solving it, then we were left on our own, and we had to struggle. In many ways, we succeeded, but we were left alone. It was a question of go do your own insurance. I think we have to talk about those systems now.
Yeah, in fact, this brings me to something that Fareed Zakaria has written in his latest book, saying that we are very, very connected, but in times of crisis, you realize how on your own you truly are. But since you were talking about risks, Mr. Nageswaran, let me ask you very quickly to highlight what you believe are the key risks that we need to be alert and watchful of. I think you're on mute, sir. No, we've lost Mr. Nageswaran. We'll try and connect with him. But Dr. Acharya, let me come back to you. Since you were talking about this business of forex reserves being used to finance infrastructure, etc., and how this is an idea that keeps getting revisited every few years, let me talk about the other idea that was put forward in the budget in 2019. The finance minister had proposed to issue an offshore foreign bond, to start with about $10 billion. It didn't take off. We're now hearing the possibility of this idea being revived. I wanted to get your view on that, given the current situation.
Yes, Shereen, there is this Rangarajan Reddy report from the early 90s, as Ashima and Ila explained. There's a hierarchy of what capital flows we want to come in. Foreign direct investment would be at the most desirable level. And in that hierarchy, the Rangarajan Reddy report would put the foreign currency denominated sovereign bond as at the bottom of the pyramid. The reason being that when the depreciation spiral happens, if the cost of borrowing of the sovereign are seen to be rising very, very dramatically, and there's a sell-off there, that is going to have a huge spillover effect on all the other borrowing markets in the country. It could be like a kiss of death, in my view. So I think the idea has rightly not been touched so far. I think we have other avenues we can explore. We can develop our corporate bond market, make insolvency and bankruptcy code a little more prompt in its functioning. We can maybe consolidate fiscally so that there is greater domestic savings going also into the corporate bond market. Not just the highest rated, but even some weaker rated corporates are able to tap into the corporate bond market. I think by and large, it would be better to get the foreign money coming into India in rupee denominated form, both in the corporate bond market as well as in the government bond markets. And I think we have a lot more to do on that front before we need to approach the idea of a foreign currency denominated sovereign bond. I think it would be the least attractive capital flow as far as a sudden stop is concerned.
Okay, the least attractive if there is a sudden stop. Mr. Nageswaran, we lost you. You were telling us about the key risks before we lost your line.
That's right. Sorry about that. Yeah, I mean, I don't think this time the key risk is that the central banks of the developed world would suddenly decide to change course with respect to their monetary policy, resulting in capital leaving developing economies like India in drove, like it happened in 2013 or something like that. If anything, this time around, the problem is going to be in managing the quantum and deploying them in productive assets, unlike last time, when most of them went into unproductive assets and the consequences of which we are still grappling with in terms of non-performing assets in the banking system. So I think that is the real challenge. So macro-prudential measures, not only with respect to capital inflows coming in from the outside world, but also internally with respect to how it is channelized into productive sectors of the economy. That will be the bigger challenge than dealing with sudden stops as it used to be in the past.
Well, I'm glad that you highlighted that big difference that we are likely to see this time around between 2013 or that period of the global financial crisis and now. Unfortunately, ladies and gentlemen, we're out of time, but thank you very much for joining us here on the Global Dialogues to take us through your views as well as what you're going to be watching out for in terms of the deployment of tools that central banks as well as governments around the world and more specifically in India should be looking at as we move ahead. Prakash, thanks for joining us. Dr. Acharya, Ashima Goyal, Ila Patnaik and Anantha Nageswaran, appreciate your time. We'll take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment.